Our next topic is finance. Finance is defined as the management of money and includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. The field of finance can be broken down to hone in on the specific types of parties involved, including personal finance, corporate finance, and public finance. Financial forecasting and financial analysis are the most important tools for valuation purposes. Let's start with financial analysis, which aims to analyze whether a business is stable, liquid, solvent, or profitable enough to warrant an investment. DuPont analysis is a useful technique used to decompose the different drivers of return on equity. An investor can use analysis tools like this to compare the operational efficiency of two similar firms. Return on equity, or ROE, is one of the most important financial ratio for financial analysis. Warren Buffett believes this is the most useful financial ratio for security analysis. He only seeks companies that have a high return on equity. In DuPont analysis model, ROE can be broken down into the multiplication of three ratios: profit margin, asset turnover, and equity multiplier. Or, ROE equals profit margin times asset turnover times equity multiplier. Profit margin is net income divided by revenue. It's measuring the profitability of a business. When you look at profit margin, you need to compare the ratio with other companies in the same industry, and compare it with the historical value for the same company. Then, you can see clearly whether the company is more profitable than other similar companies, and whether it becomes more profitable or is declining. This is very useful to identify the industry leaders and growing businesses. In the stock market, industry leaders always lead in stock price, then the stock price for other similar companies will follow the leaders. When you do investment analysis, industry leaders always have higher relative strength to the index. Relative strength is a strategy used in momentum investing. It focuses on investing in stocks that have performed well relative to the market as a whole, or to a relevant benchmark. A stock with higher relative strength is usually the leading stock with a strong trend. You need to buy the leading stocks in a hot industry with a technical breakout with big volume. That's the key for initiating positions. Asset turnover is revenue divided by average total assets. When you see an average on an asset, you add the opening and closing value of the asset, then divide it by 2. Since balance sheet only lists the year-end value, the average total assets is the average of the previous year total assets and the current year total assets. Asset turnover is useful to evaluate the efficiency of the business. It's always good to generate higher revenue with smaller assets. If you always need a lot of capital to invest in the company, there may be potential risks during an economic recession. Equity multiplier is average total assets divided by average equity. It's measuring the financial leverage, which is how much debt that a company uses to run its business operation. This is distinctive ratio to each individual company. Some companies don't use any debt, while other companies have more debt than equity. When a business is profitable, the company can use more debt for expansion and acquire new market. That's good debt. However, when a recession comes, companies with lots of debt may go bankruptcies. Leverage is always a double-edged sword. Now you understand all the components of the ROE. Hence, ROE equals net income divided by average equity. ROE only measures how successful of a company, which is related to the intrinsic value of the business. However, the market price, or the price of the stock for the company, can be quite different. Warren Buffett always says, "The value is what you get, but the price is what you paid." Even for a good company, if you pay too much, you still can't make money from its stock. So there is another important ratio called PEG. PEG is Peter Lynch's favorite investing metric. Just like Warren Buffett, Peter Lynch is one of the most successful stock investors, averaged a 29.2% annual return, consistently more than double the S&P 500 stock market index. PEG, or price earnings to growth ratio, is a valuation metric for determining the relative trade-off between the price of a stock, the earnings generated per share, or EPS, and the company's expected growth. PEG equals price divided by earnings, then divided by annual EPS growth. A stock with lower PEG less than 1 is considered undervalued, and is potentially a good candidate. But you also need to compare to other similar companies, look at macro environment, and use technical analysis to initiate the position. Now you understand all the important concepts in financial analysis, let's move to financial forecasting. A financial forecast is a framework that presents estimates of past, current, and projected financial conditions. From financial statements and financial analysis, you can understand the current situation for a company. However, investment is always forward-looking. Stock market is usually leading the economy in 6 months. When you think everything is so bad for a company, there may be a turnaround plan going forward. The next earnings report may be significantly improved. In the stock market, there is a saying, buy the rumor and sell the news. It's basically the same logic. Smart investors have information advantage, and already know that something good will happen. But when the news finally come, they will sell the hype. It's just as simple as that. In order to succeed in investment, you have to look forward. That's the value of financial forecasting. A full financial forecast consists of 3 parts: balance sheet, cash flow statement, and income statement. These are pro forma documents, or documents that are based on assumptions or projections. To do a good financial forecasting, you need to have good understanding of the business. You need to forecast the future revenue and expenses, as well as the future free cash flows. Many security analysts use complex financial models to forecast sales, but it could still be way off. For listed companies, management will present pro forma financial statements and management discussions in the annual report, which could share some insights for financial forecasting. In the end, the leadership quality is the key. The management team should be reliable and competent. This is another important criteria when Warren Buffett picks stocks. We have gone through all the important concepts for finance.